Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is president of Asset Preservation Wealth and Tax, and our special guest, Spike Spengel, radio host and live events coordinator. I love that. Good to see you.
Yes, I host his weekly radio show. We do a whole hour. I mean, you're lucky.
Amazing.
You only got him for half an hour. I had a whole hour of me and him in the booth together. KTAR, KFYI, Arizona Sports. Man, do you provide a lot of information, Arizona?
I'm everywhere. It's it's awesome. No, look, we're blessed to have the venue we do I just feel so good to be able to speak to so many people and know that we've made a difference. And so to you guys, I'm grateful for you watching and listening. So.
We put together so much information from the live events, from the radio, and from the television. And weren't you saying that we had a lot of traction from doing just topical news? If it's so much news or noise out there right now.
It has been amazing, the interest that we have received from the viewers at home and from the listeners. They just want to know, is this news? Is it noise? And Stewart, can you please help them understand what's going on? So I have a very special question, obviously. Let's talk a little bit about... I'm going to guide it to you, Spike.
All right.
What is the LIMRA? Is that how I say it?
LIMRA, and so what they do is they do reporting, financial reporting across the country. They kind of say if you're having a hard time falling asleep at night, read the LIMRA reports. We'll put you right out in a couple of minutes. But they said last year projected $100 billion went into fixed annuities last year. That sets a record. Wow. And I wanted to ask you, what do you think that's in reaction to? Is that in reaction to the volatile markets? Is that in reaction to interest rates going up and having better choices out there? Why do you think so much poured into fixed?
Well, I think what people did is they experienced the pretty bad experiences in variable annuities. I think variable annuities, people realized, had just as much risk as the stock market itself. And while they provided some guaranteed income solutions, they didn't provide, for the most part, any sort of principal protection. And so, with a variable annuity, they're just really, really expensive. And I think to kind of start the conversation off, what I think makes sense is to kind of explain the different kinds of annuities.
Can you maybe give us a breakdown? Because fixed it's very specific, but I've heard things about variable, and then you've got immediate, maybe a little baseline for everybody.
Yeah, so when a lot of people hear annuity, a lot of times they think about the lottery, right? And that is when you exchange a dollar amount for a payment over time or over your lifetime or whatever. So like when you win the lottery, you can take it out over 20 years, right? Or over life or whatever the options are. Well, that would be like a SPIA or a single premium immediate annuity. Generally, there's no risk associated with that other than the strength of the underlying company. Always do business with only A-rated companies, A- at the bottom end. I wouldn't do any business with B-rated carriers. It just adds too much risk. That's number one. Number two, what we have are what we call MIGAs or MIGAs. They're multi-year guaranteed annuities. And what those are is when people buy, they say they have $100,000 and they want to put it away for 3 years, 5 years, 7 years, whatever. Well, it guarantees a certain interest rate for a certain period of time.
That starts to me sound like a bank CD.
It is, except it's issued by an insurance company, not by a bank. So, it doesn't have FDIC insurance, but it's guaranteed by the issuer. So once again, you want to make sure you're doing business with a strong company. And then you have the variable annuities that we were talking about. And variable annuities are like being in the stock market, except generally they have all of these riders attached to them. And what those riders do is they'll usually be a guaranteed income for the rest of your life. And what we're seeing a lot of is 2, 3, 4% of fees built into these things. So you're paying generally about 1% for fund fees plus mortality and expense fees. And if you take a look, I have this graphic I want to show you. It's the S&P 500. If we pull that up, what you'll see is there's a period of time, you see the two humps, the hump starting on the left there, the furthest left, that is the dot-com crash. And we saw a lot of variable annuities, and we tend to see them when the market does well because they illustrate well. But if you look from 2000 to 2012, the market made nothing. It took 12 years for the S&P 500 to get back to where it was in 2000. So now let's go ahead and say, okay, well, if the S&P 500 or if a variable annuity did exactly as well as the S&P 500, which is usually not even close to being the case, but then you add 4% in fees to that, well, all of a sudden, you have half the money you started with, even though the market's back to break even. Why? Because the fees don't go away when the market goes down. That's generally a problem. They're really expensive. They have a lot of risk. And then we have the final kind, which is the indexed annuity. Now, the indexed annuity or fixed indexed annuity is like a hybrid between a fixed account or a fixed annuity and a variable annuity. And there are all kinds of variations there as well. And what it does, generally, the underlying principle is that when the market goes up, you go up. When the market goes down, you don't see any downside loss. It has a ratcheting mechanism for most of them. Now, the concern I have when it comes to annuities, and I actually sit on a design committee for one of the largest insurance companies in the world. My voice isn't always welcome, just like here on TV. Some of you don't like what I say.
Come on. No.
But at the end of the day, I don't like product that has bells and whistles that you're never going to use. A lot of these
that you're paying for along the way.
They're not free. They always cost something. So if you have been seeing an advertisement that said, hey, 10% bonus, or
I'm seeing those all. You get a 25% bonus or 15% bonus. What is the first of all, what does the bonus even mean?
Yeah, so you have to understand, insurance companies aren't just going to give you a bonus because you're a nice person, right? Or then the advisor may even tell you, hey, that's, because we take lower commissions, we can give you a bonus. It's just not true. All it is, generally, those bonuses are not going to the value, they're going to the income value. So remember, a lot of times, even when interest rates are low, where we're seeing these accounts, when the 10-year treasury was paying 1 or 2%, we were seeing guaranteed 6% income, guaranteed 7% income. Well, that sounds good, right? 6 or 7% income, right?
Of course, absolutely, Stewart, yes.
But remember, that's income, not interest. Income is what you take. Interest is what you make. And so oftentimes they're conflating these words. They're confusing you with the words income and interest.
I hear 7%. I think I'm making 7% interest.
I would think
but
that
that's only if I turn on the income itself and take that for the duration. That's the only way to get the 7%.
And so all they're doing, so let's just say that when you turn on the income, they guarantee you the account makes 7%. Once you start taking income, that accumulation stops, but then you're guaranteed 5% for the rest of your life. So if you're 65 years old, and you're buying one of these accounts for income purposes with income riders that you're paying for, well, generally you start that 5 or 10 years down the road. So let's say you start at 5 years down the road at age 70. Well, if you can take out 5% a year, you have to be 90 before you get your money back, because all they're doing is handing you back your own money. So these lifetime income products are just it's like you giving me $100 and me giving you $5 a year for the rest of your life. Well, that's a good bet if you're 65, 70 years old, because statistically you're not going to live to 90, right? So I try to stay away from all that nonsense, all those expensive riders. I think they're a mistake. I've been saying it forever. And if you're being pitched an annuity with these income riders and you have concerns about them, honestly, it's one of those things you should get a second opinion. We'd be glad to review it with you. We're fiduciaries. We'd be glad to give you our neutral opinion on them. The accounts we like to see are the ones that have none of those riders. When we come back, I'll tell you what I like and how they're designed. But if you have concerns that you have one of those kind of annuities, those variable annuities or those index annuities that have all of these riders built into them, then give us a call. We'd be glad to give you a second opinion. If you give us a call at 833-652-7829 or pick up your phone, click on that QR code, we'll give you a complimentary annuity review if you bought one of those. If you have concerns that you're deferring taxes, if you're taking too much risk or you're paying too much fees, give us a call. Take action. We'd be glad to give you that second opinion.
Stewart, thank you so much. And Spike, thank you so much. To our viewers at home, that number to call is on your screen, 833-652-7829. We have to take a very short commercial break, but today's episode is very special. These are ripped from the headlines. Everything we're going to be talking about today is correlating with what you're seeing online. This next one is actually from the Yahoo Finance, so please stay tuned. I'm going to talk about what that is the moment that we return from this quick commercial break.
People are really concerned about outliving their money. Inflation, taxes, volatility in the markets, legacy. That's what people are really concerned about. Listen, I love what I do. when a client of mine can know with total confidence that they're going to be okay. At Asset Preservation, that's exactly what we do. Not only do we look at your investments, we look at your taxes and estate planning as well. We don't leave any stone unturned. That is what a real holistic shop does. Provide a very clear roadmap so that you know it's okay to enjoy retirement. Success is being able to sleep at night. And at the end of the day, what we provide at Asset Preservation is not only the market expertise by institutional money managers that are some of the biggest and best in the world, but we also provide complete advice. You need to make sure you have a plan. What you can expect from us is to let you know the truth about your portfolio.
Welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is president of Asset Preservation Wealth and Tax, and our special guest, Spike Spengel, radio host. I love today's show. Ripped from the headlines. Is it noise? Is it news? What is it? This next one, this is from Yahoo Finance, gentlemen. This is a great question. It says, I finally retired. What happens with my 401k now? I think a lot of people have that question in our audience today.
Cynthia, I was so glad when you shared that. I was reading through the article myself, and what I was finding is that they were giving you ideas and thoughts about how to decumulate from your 401k while leaving it at that plan administrator. They never, throughout the time, and Yahoo Finance is huge. I mean, millions of readers every single day. And they publish some great stuff. But the problem for me was they didn't talk about taking it out from the plan administrator after you leave work. Is this what you do with clients?
Yeah, so I mean, listen, you know, when you're leaving your money inside an existing workplace, you're basically generally having to make those investment decisions yourself. And as the economy changes, oftentimes these old plans don't keep up with the new management styles. You know, there's a whole different way to look at investments in this new kind of investment regime, and I think it's important to consider that. Now, look, there are some downsides, right? Having your money inside of 401k has something we call ERISA protection, so you want to understand whether that relates to you or not, especially if you're in California. In Arizona, we don't have quite as many concerns there. But the other thing is, there are loan provisions inside your 401k, but generally when you're done working, you don't take those, or you're not allowed to take a lot of those loans out of your 401k. So while you're still working, there may be loans in force and so forth. But listen, Spike, I'm telling you, most of the people that we see that have loans, they end up defaulting on them when they retire anyways. They don't ever get it paid off. Yeah. And sometimes we actually call it a strategic default. So when we do our advanced tax planning, I know I'm kind of merging subjects here, but we actually can create a strategic default for people to default on their loans. And it's almost like, because remember, like, let's say you have a $500,000 401k, but you owe $50,000 on this loan that you've borrowed. Well, it's been an efficient loan. It's made sense. But when you retire, do you have to pull 50 grand out of your savings to pay this thing back? Or maybe it makes more sense to just not pay it back. But what happens is you get a 1099 and have to pay the tax bill on it, right? Yeah. But you want to plan that tax hit, not just take it or not to expect it, right? You want to know it's coming and know how to strategically plan it.
Absolutely.
So, you know, in terms of, you know, does it make sense to leave it in a 401k or have it professionally managed? Everybody's situation is different, but I certainly think it makes sense if you're uncomfortable handling the guidance of your own investments, then maybe it makes sense to roll it over to an IRA, but you have to be willing to give up some of those ERISA and loan provisions and so forth.
Okay, and I understand that, but you're also not really getting tactical management advice. You're the one setting the percentages and the parameters of what you're invested in. You don't really have a money manager, so maybe is that a second question? Do you want to manage it, or do you want to have somebody else manage it for you?
Well, the question I would ask you is, you know, what if you're wrong? Right? You know, it's just like dealing with a financial advisor that's picking all of the stocks for you themselves, all by themselves. You know, oftentimes when you go to, you know, some of these firms, the advisor is the guy saying, hey, I like this stock or this fund or this bond or whatever. And my question to you is, what if they're wrong? Or even more importantly, managing your own 401k, what if you're wrong? What if your husband's wrong? What if your wife is wrong, the one who makes the stock picks? You're going to bet your whole life savings. You have to put into perspective, Everyone got it right for the last 14 years. Everyone made money. You know, I have clients all the time that'll say, no, but my husband, he tripled our money over the last, 15 years. Well, great. The market quadrupled. You only underperformed by 25%, right?
Yeah.
I mean,
then ask her, what did he do last year?
Yeah.
How did it perform last year?
You know, and that's the question, right? I mean, so does it make sense to have it professionally managed? In most cases, I think it makes sense to get a second opinion to find out whether you're properly allocated or not, and whether or not it makes sense to have somebody else look at it. Because, just remember, I know in the next segment, I kind of cheated and saw it, but, there's a quote from BlackRock in there, biggest money manager in the world by most standards.
Well, okay, we had compliance, biggest, or we could say one of the largest money managers, but they really are. They've got
compliance likes me to say it's one of the largest. It is the largest in my opinion.
Okay.
I think that qualifies. Anyways, listen, a lot of people don't like BlackRock very much. Why? Because they're very liberal. They, do ESG funds, etc. But here's what I was saying, kind of tying that into the previous answer, is that if you've got an advisor that's picking the stocks for you, or you're doing it yourself. And I asked that question, what if they're wrong? Well, at Asset Preservation, what we do differently is it's not me picking stocks for you. It's not me picking bonds. I have clients all the time that'll come in, Cynthia, and they'll say, well, hey, do you like this stock or this fund? I don't know. That's not what I'm not a stock picker. It's not what I do. What I do is I manage wealth. And the way we do that is we coordinate it with multiple money managers, right? So we have an algorithm money manager that for years has been absolutely unbelievable. They have an algorithm that basically, when the markets look good, they hit the gas. When the markets look bad, they hit the brakes, they move out of the way. And they've done it impeccably for years. Last year in 2022, they were terrible. They were absolutely horrible. But the good news is we don't have 100% of people's money in that account. We split it between multiple money managers. And so what I'm telling you guys is that, no one's going to get it right all the time. And that's the thing. We split it between, we do have a relationship with one of the largest money managers in the world. I'm not going to say their name because I'm not allowed to, but I can't say who it is, right? But we also have a money manager relationship with a guy named David Young out of Newport Beach, spent 14 years at one of the biggest bond houses in the world. And guess what? They all see the world differently. If you watch a conservative news channel, you'll see the world one way. If you watch a liberal one, you're on a completely different planet. Like me, I'm already confused, right? I'm kind of a centrist guy that went to Berkeley, which makes no sense, right? Like, so I think it's important to make sure you have multiple points of view reflected in your portfolio. And when I tell you this, I tell you sincerely, the most dangerous advisor is the advisor that thinks they're smarter than they are. I'm pretty, critical of myself. I joke about, hey, I don't know what I'm doing. Listen, you don't want the person who thinks they're smarter than they are. That's what's going to get you into trouble. Right?
I'm more worried about someone who says, I know what's going to happen in the markets. I know what's going to happen in investments, because time after time after time, study after study, it's proven. Nobody knows what's going to happen in the markets from year to year to year.
And that's why you spread the risk.
Absolutely. It makes perfect sense. Well, I have a headline for you, Spike, but I think we're going to actually take a commercial break first. I know you have a very special offer, Stewart. Let's talk about what that is before we go to the phones.
Absolutely. So if you're concerned that all your eggs are in one basket, that all of your investments are being guided by one point of view or one perspective, and you're concerned that you're not properly diversified from a perspective, then give us a call. We'd be glad to give you a second opinion. If you give us a call at 833-652-7829 or pick up your phone, click on that QR code, we'd be glad to give you that second opinion. And like my good buddy Brian Corwanta says out of Pennsylvania, great financial advisor, he always says, you can't get a second opinion from the guy who gave you your first. So feel free to reach out for the first 10 callers. We'll offer you that complimentary portfolio review. 833-652-7829. We'd be glad to give you that opinion.
Stewart, thank you so much. And Spike, thank you so much. To our viewers at home, that number to call is on your screen, 833-652-7829. We're going to take a very short commercial break because we're a little short on time. But when we come back on the Asset Preservation Hour, I have a question for Spike. It's ripped from the headlines, and it's a question regarding BlackRock. So stay tuned.
Right now, the market is a big mess. And oftentimes people feel lost. So while most people are scared, you need to know that you're going to be okay. I'm sure you have a lot of concerns about whether your portfolio really fits you. And if you need help, all you have to do is give us a call. At Asset Preservation, what we offer is a complimentary portfolio review. We can provide that fresh set of eyes to give you that second opinion. You can't get a second opinion from the guy who gave you the first. You want to make sure you're dealing with a fiduciary. We'll give you that fiduciary perspective. If you have a relationship with a financial advisor that you don't entirely enjoy, I think that's a problem, because these relationships are not meant to be short term. They're meant to last a lifetime. You don't want to deal with people you don't like. If you have concerns about your portfolio, you need to give us a call.
Welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is president of Asset Preservation Wealth and Tax, and our special guest, Spike Spengel, radio host. Spike, I'm going to guide this next one to you, and again, it's news or noise. So we have something from BlackRock. BlackRock says throughout your old investment playbook, we're headed for a new regimen of greater macro and market volatility.
Yeah.
Thoughts on that?
Yeah, Stewart shared this. We did this on the radio show just a few hours ago, actually, here in the Tempe broadcast studios. BlackRock, as we say, one of the largest money managers in the world. We know they're definitely one of the largest. And they're saying we've got to throw out the way that we invest because of the new greater macro and micro market volatility. We've seen markets move 500, 1,000 points in the matter of a few hours lately. That's not how it used to move. Now, we do realize that the valuation in the markets is bigger than it used to be 20 and 30 years ago. But what do you see happening in the next year or so? More volatility?
Yeah, I mean, but so we're seeing volatility both from a points perspective and a percentage perspective. So what I think Spike was trying to say is, yeah, well, the stock market is higher in points, so of course there's going to be more point volatility. You know, some people say, hey, it moved 20 points or 30 points, or and they're using that, they're kind of flashing back in time to 20 years ago where 20 points was a lot. It's nothing now because of the size of the market itself. But we're still seeing the same kind of percentage changes that are just awe-inspiring. I mean, when you see a 2% change in the market in a day, that is craziness, right? And so people have to get used to that kind of volatility, because I have clients all the time that'll call in. I had a client the other day that literally has like 80% of her money in fixed guaranteed assets and has like $40,000 out of, gosh, I mean, I want to say it's $700,000, $800,000 that's in the market. And she's like, Stewart, I'm down $300. I'm like, whoa. If you're worried about $300 out of $800,000, you have no business being in the stock market at all, right?
Yeah.
Like if that kind of micro volatility, we are not in a growing market where the market's going to keep shooting through the roof forever. And the reason I think BlackRock's right about this is, and first of all, BlackRock is, I don't care where you stand politically, they are one of the smartest companies in the world. They have a program called the Aladdin program. When I was doing some due diligence, we visited their San Francisco office, and this Aladdin program is unbelievable. It measures everything. I mean, it is the greatest supercomputer algorithm that measures everything from CEO sentiment to public sentiment to earnings. Wow. I mean, it uses so many data points. It is absolutely crazy, you know, and going into
so they can do like a CEO sentiment of Elon Musk and of Meta and Zuckerberg, and it's crazy.
It is, and it has, and they were explaining, it reads through the public statements of CEOs and executives, and it can parse language that's present there where, you know, like 85% of the time when this word is used, it does this. And so it's a really smart company. But people are opposed to them that are conservative because they have these ESG funds, right? Environmentally, socially conscious governance funds, which I get, I understand. Don't care. I don't have any, fight in here. I don't care.
You have a dog in the fight.
Yeah, I'm not as fancy with you as.
Let me ask you this. So how do you then aggregate this information for clients? Because I know that's what you do in the offices. A lot of this stuff, I'm like, oh, that's great information, and I could go read it myself. But then you take this all in, you filter it. How are you applying? When they're saying throw out the old investment playbook, are we talking the 60-40?
Well, yeah. I mean, so just remember the 60-40 really worked, which is 60% equities, 40% bonds, or inverted 40% equity, 60% bonds, depending on whether you're conservative or balanced. But that worked while interest rates dropped. Now, if you're in a position, and I have this slide, I don't know if it's ready or not, but it's a comparison of the S&P 500 overlapped with TLT. Since we're talking about BlackRock, TLT is their 20-year Treasury ETF. On the top in gold there, what you're seeing is the S&P 500 last year dropped 19.45%. If you were conservative and were in a long-term bond ETF like TLT, which has historically done really well, it dropped 32.68% last year.
And I want to keep that graphic up there right now. So the S&P 500 is going down there, but so is the Treasury bond. Don't they usually work inversely? What in the world happened last year?
So what happened is that we saw this massive spike, no pun intended.
Thank you very much.
Not you, Spike. We saw a massive spike in interest rates, and that really created a bond crash. And so what I would ask yourself is, if you have bonds, for example, and you are conservative, well, maybe it makes sense to rethink that strategy. Because look, even if the 10-year Treasury today is right around 4%, does it make sense to take for the upside of getting a 4% yield, does it make sense to take the risk of losing 30%? Well, to be fair, when I said 10-year Treasury, the 10-year ETF, which is IEF from BlackRock also, that's down right around 19%, about the same as the S&P 500 last year. But is it worth risking 19 or 20% to make 4? Right? Generally, when you take that kind of risk, you want to be rewarded appropriately.
Of course.
And I think oftentimes people don't understand the risk versus reward. People look back.
You're basically saying, do you want to bet $20 to maybe win 4?
It makes no sense in a lot of situations. There's safer ways to do it. And if you have concerns that you're way too exposed to an old way of thinking and you aren't prepared for the new economy, then maybe it's time to get a second opinion to reassess where you are, because you've worked really hard your whole life to put this money away. If you want to make sure that you can stay in retirement safely or go into retirement safely, give us a call, 833-652-7829. We'd be glad to give you that complimentary, absolutely free second opinion on your portfolio. But you have to take action. You have to take the step to give us a call or click on that QR code and seek help, because we're here to help.
Stewart, thank you so much. And Spike, thank you so much. To our viewers at home, most specifically, thank you for spending time with us today. That number to call is 833-652-7829. We know you have a lot of questions for Stewart about everything you're hearing in the news right now. He has the answers for you. Again, 833-652-7829. Be safe, be happy, and be blessed. We'll see you back 1 week from today on the Asset Preservation Hour with Stewart Willis.